Ladies and gentlemen, the stock market is soaring higher today, as I predicted it likely would in 2025. Now, here in this video, I will explain what is going on today, the news that you need to know, because there was a little bit of data that came out today that definitely did help markets to move higher. But there is one obvious reason why markets are moving higher, and it's really as I predicted in previous videos. First and foremost, people were way too bearish heading into 2025. Now, I think the bearishness was more tactical than anything else because nothing changed, okay? We didn't really get new information. The bull thesis kind of was the same. We did see, though, a lot of tax loss harvesting, and we did then start to see some profit taking in big tech in the last couple of days of 2024. This most certainly was the biggest driver of markets lower in the last couple of weeks. Now, what is happening today? Well, the big thing that's happening is, well, we're now in 2025. And people are starting to, what it looks like, reconsider how bearish, how fast we got. Okay, the CNN Fear and Greed Index hit a low of 26 yesterday, which was almost an extreme fear. Today, you're still at 31, which is in the bottom third or bottom quartile, as I like to call it, of the fear category. So you're still very much like fearful. There's still a lot of room for markets to bounce higher here, but today is a good start. Market momentum is still in fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options is neutral. Market volatility is neutral. Safe haven demand is fear. And junk bond demand is currently in greed. The other big thing that I was pointing to was the percent of stocks trading above their 50-day moving average. Even after today's rally, you only have 36% of stocks trading above their 50-day moving average. That's about 64% of stocks that are trading above their 50-day moving average, meaning that still about 2/3 of stocks are in a pretty severe downtrend. Okay, with those kind of conditions, you are ripe for a reversal. Anytime you're in a bull market and 30% of stocks are trading above their 50-day moving average, or even 28%, as low as what we hit yesterday, you want to be a buyer of that market. Unless something dramatically changed and there's, something that happened, you want to be buying that dip. Nothing changed, nothing happened, thus, you wanted to buy that dip. Okay, and I hope some of you guys, at least a few of you, listened to some of the videos that were put out over the past couple of trading days. Now, that does not mean we're in the clear indefinitely. There's three major risks to markets in 2025. Number one is the economy and a recession. If we slip into recession or the economy starts to look down and look like we could go into recession, markets are going to fall. Okay, markets are not going to be in a great place with that kind of backdrop. Number two, a resurgence in inflation. I personally think inflation is going to come into the downside. I don't think under Trump 2.0 we're going to have the kind of inflation issues that we have seen over the past couple of years. I think inflation is going to fall a lot more than Wall Street expects in 2025. The third big risk is extreme Trump tariffs. Now, believe it or not, to a certain extent, Wall Street is comfortable with tariffs at this point. Like, if Trump gets into office and he does a 10% blanket tariff on everything, with obviously some companies that will get exemptions like they did in 2018, I don't think that is super negative to markets. I think actually that would cause markets to rally because it wasn't as bad as feared or wasn't as bad as what it could have been. Okay, so that's the third risk. These are risks that will be with us in 2025. And I think the level of fear could fluctuate, okay, as different data points come out, so on and so forth. But today, is very much a step in the right direction for the bulls. Again, we were so bearish though. This is not like rocket science. When markets are that bearish during a bull market, you want to be buying. Okay, and that's what I have stressed here on this channel. But as well as that, the VIX was at 19. Today, it's down about 9%, almost 9%, down to 16.39. That's still pretty high. There's still a lot of room for fear to come out of our markets, for people to get repositioned back into our markets. Because here's the deal with tax loss harvesting and profit taking. Specifically tax loss harvesting, you have to sell a stock and then wait 30 days to buy it back. It looks like there was a lot of tax loss harvesting throughout all of December, so there could be a lot of buying throughout all of January. As people get back into those positions they tax loss harvested. The Russell was obviously an area that's seen a lot of tax loss harvesting. The equal weight S&P, just, random stocks in the S&P, also had a lot of tax loss harvesting. Now, I do still think the S&P has some vulnerabilities on a headline basis in early 2025 because big tech is no longer the only growth area in town, or is at least expected to be not the only growth area in town. It's really going to be more of a broader based growth outlook in 2025. Small caps and mid caps and value and cyclicals, healthcare and industrials should be able to grow more year over year EPS in 2025 compared to just big tech that was really the leader there over the past 2 years. So that also puts pressure on big tech. Now, big tech multiples are priced for a lot of growth, so I think this earnings season is going to be important for specifically big tech. We gotta still justify Apple trading at a 30 plus forward PE for 2025, with very little growth. It was actually reported today that iPhone deliveries or shipments out of China were down over 40%. Okay. That's not exactly like super strong data to justify where Apple's multiple is currently at. So I think there's some risk there, and I think that's why you will continue to see a broader market rally in 2025. Now today, 10-year Treasury yields are moving up a little bit, but mainly unchanged on the day today. Now the big data that came out was ISM manufacturing PMIs. They came in at 49.3. Last month was 48.4. The estimate was 48.5. So we came in considerably higher than the estimate. Now this marks 3 months in a row of manufacturing PMIs getting a little bit better than the previous month. Okay, so looks good. Out of the components, manufacturing backlog of orders did come down from 42.3 down to 41.8. Manufacturing employment came down as well from 48 to 45. ISM manufacturing inventories did go up from 42.6 to 48.1. New orders went up into positive territory from 50.4 to 52.5. Manufacturing prices went from 50 to 52.5. Manufacturing production stayed relatively stable, going up a little bit from 46.2 to 46.8. And manufacturing supplier deliveries dropped from 52 down to 48.7. Overall, pretty solid numbers. Like, could they be better? Of course. I would like to see the backlog of orders a little bit better. I would like to see employment a little bit better. And I would like to see prices fall. But overall, it was not a terrible report today. And if we do start to see manufacturing recover, yes, that's only 20% of the economy. 80% of our economy is services, okay? But if you start to see that 20% of the economy recover, that could start to be a good thing, right? That could start to kind of elevate, I think, consumers, right? Because a lot of people that work in manufacturing are your average citizens, right? So that could be a really good start to 2025. And that is part of the reason why markets are moving higher, really in conjunction with the oversold conditions we had in markets, the overly bearish positioning that people started to have, and what could be now some rebuying of those tax loss harvested positions. Today is Friday, so that is the last trading day of this week. On Monday of next week, we will have Fed Cook that will speak, factory orders month over month, and final numbers for S&P Global Composite PMI and S&P Global Services PMIs. On Tuesday, we will get ISM Services PMI. That's going to be an important one, again, considering 80% of the economy is services. Exports, imports, and balance of trade, as well as the JOLTS job openings number. You're expecting job openings to fall by about 100,000, but any big drop would likely be seen as negative. On Wednesday, we will get the ADP employment change, expecting 140,000, which would be a pretty solid number overall. Fed Waller speaks on Wednesday, and you have the FOMC minutes. On Thursday, you will get Fed Harker that speaks and initial jobless claims. Initial jobless claims expected at 210,000, as well as challenger job cuts expected to ramp up to 65,000. And that's a big question that I personally have is now that we're through the holiday period, how much laying off do you see? Okay. Do you see some really weak jobs reports over the next 1, 2, 3 months? Or are things not that weak? I think that'll tell us a lot about the underlying economy and how businesses are feeling for 2025. Now, on Friday, your big data comes out. That is non-farm payrolls, expecting 150,000, as high as 200,000 for that payroll number. And the unemployment rate is expected to move upwards, at least a little bit, from 4.2% to 4.3%, which any move higher in the unemployment rate is going to be the highest unemployment rate that we have seen in the last couple of years. That could be a bit of a problem for markets, although I'm not certain whether, good data or bad data will be seen as good or bad news for markets. Bad data or worsening data would mean more cuts from the Fed. That's positive, but would mean a greater chance of potentially slipping into a recession. So what do markets like more? Do they like good data, which means less cuts and a better economy? Or do they like, weaker data, which means more cuts and it may be a recession? I don't know. So I think this upcoming week is going to tell us a lot. I do think overall we are set up for a continued rally in markets. The next big issue that I think markets will contend with is the inauguration. If we sell off into the inauguration, then we likely get to buy the news event after the inauguration. If we rally into inauguration, then we probably get to sell the news event, and we probably get some fears about tariffs. Overall, I'm not too concerned because I think we've kind of priced in a lot of the tariff risk already. But, depending on how markets react heading into January 20th, it could, give us an opportunity to position to one side or the other, potentially to hedge positions or potentially to buy before that inauguration. Again, depending if markets sell off or rip higher heading into that event. We do have earnings season that will kick off January 15th with your major banks. Name the bank. It probably reports that week. Okay, not next week, but the week after that, and then the week after that, and then the week after that. So like 4 weeks from now, we will start to get bigger tech earnings, and that will be the next big set of catalysts to drive markets higher or to drive markets lower. In recent history, earnings have beat expectations, and I think they're probably going to beat expectations for the holiday quarter as well, which could be another positive catalyst heading into really, end of February, March or so. Then we will get NVIDIA earnings, and boom, markets will care about that again. Although I don't think NVIDIA is going to be as big of a catalyst in 2025 as it was in 2024, it's kind of like Apple. That was this huge catalyst in 2023. Like, if Apple had missed on some of those earnings, the markets would have crashed, okay? Apple was kind of the NVIDIA as far as earnings reports in 2023. Then it was NVIDIA in 2024. I don't think it's going to be the biggest catalyst. I think it's more about software and about AI appliers, company like a Tesla in 2025, in terms of really the next leg of the AI story. And that's why I'm bullish on AI appliers, not as bullish on NVIDIA, not as bullish on big tech. I think it's about the AI appliers, companies that are actually doing something with the NVIDIA, GPUs that they have already bought, right? We got to see some use cases from AI. We want to see some companies actually start to put forth some growth numbers from AI. And I think that's why I like Tesla a lot for 2025. Even though it's went up a lot, I think $402 per share is a great level to be buying. Could be wrong. We'll see. Let me know what you think happened today for markets. I think it is open to interpretation, and I don't think I'm definitively 100% correct. There could be other things that happen. We had some Fed speakers today. It really didn't sound too bullish or too bearish. It was kind of in line with expectations, which also could have been a positive for markets. You never know these days. So let me know what areas you're buying in our markets and how you're positioning for the next couple of weeks. Thank you for watching, ladies and gentlemen. Enjoy the rest of your day, and I will see you in the next one.